Welcome to MarketVelugu Conversations. In our first episode, I'm joined by Pankaj Khanna, a shipping industry veteran and the CEO of Heidmar Maritime Holdings. Pankaj, welcome to MarketVelugu. It's great to have you here.
Good to see you, Manoja. Nice to be here.
Thank you. So, when we look at oil, we usually refer to the price of oil. But behind every barrel that moves from the producer to the consumer, there's an enormous physical transportation system that most investors barely think about. So, Pankaj, for someone who follows oil but not shipping, what does the shipping market tell us that the price of oil alone cannot?
Well, as you know, oil is not necessarily produced in the areas where it is consumed. So oil has to be moved. The world consumes about 104, 105 million barrels per day. Of that, about 60% has to be moved somewhere on a ship. And obviously, until the war happened in the Middle East, people didn't realize that this oil was moving and how important the role for shipping is. Not just for oil, but energy in general, and in general, in terms of what we consume. Anything you look at in your room, about 90% of what you have in your room has been shipped from somewhere on a container vessel, etc. But in terms of energy, liquefied natural gas, liquefied petroleum gas, CO2, ammonia, crude oil, and then petroleum products are all moved from somewhere to the consuming areas. So shipping is critical to our lives in terms of energy, in terms of what we consume, in terms of food, so grains, dry bulk carriers, steel, coal burned in the power plants, and then also container vessels. So shipping is critical to our well-being as human beings today.
Yes. And before we get into geopolitics, can you give us a simple picture of the tanker market? Who owns the vessels? Who manages it? Who hires it? And what ultimately determines freight rates?
Yeah, so tanker shipping is probably one of the most efficient markets out there. So you have the oil companies, whether it is the national oil company, oil majors, independent oil companies, oil traders, who are either producing oil or moving oil. So production can be by a national oil company in a country, but then the oil is moved by somebody who buys it from the terminal and then moves it to somewhere. There are the refineries, which are in different places, also can be owned by either the oil companies themselves, independents, traders, etc. And then in between all of that is the tankers. Tankers are mostly not owned by the oil companies. So back in the 60s and 70s, the oil companies experimented with this, where they went all for vertical integration and tried to own all aspects of the chain. However, over the last 50, 60 years, that has changed. So it's not just with regards to tankers, but also refineries, for example, are also owned by many independents. The oil companies have gotten out of refineries over the last 10, 20 years or so. Not completely, but of course, there has been some divestment over there. So tankers are owned by independent owners in the main. You have the Greeks. So about 20% of the world fleet in general in shipping is owned by Greek ship owners. But then also the Japanese are quite large in tanker shipping. You have the Chinese company COSCO, which is very large in tanker shipping as well. So it's a very fragmented industry. There isn't one owner that owns 20% of the fleet. It's quite a fragmented ownership. Ownership is residing in different countries. So Greece is number one, probably China is number two, then you have Japan and so on. It's not that the tankers are owned, for example, by American companies. There are very few American companies, if any, that own tankers in any substantial numbers. There are hardly any Canadian companies that own tankers in any substantial numbers. So then that's with regards to the ownership. As far as the management is concerned, the management is split in two, effectively, in-house or external. So some owners decide to do the management themselves as well. So management of the vessel refers to two aspects. One is technical management, so which is the crews on board the vessel and the system to maintain the vessels. And then there is the commercial management. The commercial management is the employment of the vessel. So there are some owners that do it in-house, so they have their own cruise management systems, their own personnel to do the commercial aspect. And then there are others who outsource it. I would say that the market is split 50-50 at this point between owners who do it in-house versus owners who outsource.
So, where exactly does the commercial manager create value?
So, in tanker shipping, you have clients who are very picky in terms of who they do business with. So, your clients are the likes of Exxon, BP, Shell, Chevron, Aramco. So, national oil companies, oil majors, Vitol, Trafigura, large traders. And the cargo that we are moving is also very sensitive with regards to the risk of pollution, safety risk. So they're very finicky about who they work with. So where we come in as Heidmar, we have been around for more than 41 years now. We have been KYC'd, know your client. So we've been cleared by every oil company and trader on the planet to do business with. They know us, they have worked with us at some point or the other, either currently or in the recent past. So this is one very critical aspect in terms of working. So if you are a billionaire, you're Bill Gates, and you go to Aramco today, the Saudi national company, the largest oil company in the world, and say, I've just bought a ship, a brand new ship, and I want to carry your cargo. Aramco will say, okay, great. Mr. Gates, please go to Heidmar. We don't know you. We have not KYC'd you. We don't know the company that you have set up. We have never operated with you. We don't know the philosophy of your company. We don't know if you have systems in the company to carry this sensitive cargo. So we would prefer that you go to Heidmar and then we'll fix your ship through Heidmar. So where we add value, number one, is that we've been KYC cleared by everyone. Number two, we have 41 years of experience working the global trades. So we have relationships with all the companies. So not just working in one region, in either in Asia. So let's say you are an owner in Japan and you work mostly around the Asia Pacific. So you have relationships in Singapore with maybe Chinese, with the Japanese in the Arabian Gulf, but you don't have relationships in the Atlantic, in the US, in Europe, etc. So we are global. We have offices in 9 countries and we have relationships built over 41 years. And then the third aspect is operations. It's not just enough to fix your ship, charter your ship to an Exxon, but then you have to execute the voyage. With shipping, we always have problems. So, for example, we loaded a ship on completed loading in Ras Tanura in Saudi Arabia on the 28th of February when the war broke out. We came out of Ras Tanura, and now suddenly the straits were closed for over 4 months. Now, we had to deal with this problem, but we have experience from 40 years of dealing with problems like this. We have dealt with sanctions in Venezuela. We have dealt with problems in Russia. We have dealt with sanctions on Costco. We have dealt with closures of straits in the past. We have dealt with wars. I personally, in 1990, my second ship, I was a cadet on a ship, and this was during the first Gulf War. So I was on a VLCC loading cargo in Ras Tanura as Scud missiles were flying over from Iraq into Saudi Arabia. So we have the experience to deal with problems. And when a problem comes up, we have a commercial outlook to the problem. So we always first say, yes, let's see how we can do it, rather than saying, no, we can't do it, because that's the way a lot of people deal with problems. So the combination of the fact that people know us, we have relationships and experience over all this time, and we deal with problems in a more commercial, flexible way is why people want to do business with us, which is how we add value and get the highest earning possible for a ship owner.
So, what kind of problems do the tanker pools solve for individual ship owners?
So if you are a ship owner, imagine you fixed a ship on the 24th of February of this year, before the war broke out. And the rate was still very healthy, maybe $200,000 per day for a VLCC. But then the very next day, or in 4 days' time, when the war broke out, the rates increased to $500,000 per day. Now you have no access to that. Now your ship is stuck, maybe inside the Middle East. Maybe it is out, but maybe it's stuck inside the Middle East. So you have a problem being a single ship owner, having just fixed a voyage at that rate, whereas the market has gone up to double of what it was. So when you are in a pool, the earnings are aggregated across the number of ships that are operating in the pool. So there is one aspect about the timing, where if you have timed the market wrong, you completely miss out the market. And the volatility in the tanker market is immense. And then the second aspect is geography. Let's say you are trading in the Asia Pacific with a vessel today, and the earnings are $50,000 per day. But the same ship type in the Atlantic is earning $100,000 per day. Now, if you're in a pool, there are some ships in the Atlantic, some ships in the Pacific. You get the aggregation, so you get the benefit of the geography. Economies of scale. So we're buying fuel for all the vessels in the pool. If you were a single ship owner, you go to a trader to buy fuel oil in Singapore. Let's say you get $700 per ton. Heidmar will buy the same fuel at 675, $650 per ton. And also with regards to availability, the trader will give the fuel to me first before they look at giving it to the single ship owner. The same thing about insurance. The cost of insurance goes down because we are buying for the pool of vessel. But the most important aspect is cash flow. When you are a single ship owner and not in a pool, you have to fund the entire voyage. Let's say you completed discharge in Japan and your next load port is going to be Houston, back in the US Gulf on a VLCC. So you have to fund the entire voyage from Japan to Houston, load your cargo, and then go back, let's say, to Japan. This is now a 90 to 100-day voyage. And so all that funding has to come from your pocket. Whereas if you're in the pool, I have a working capital facility, I provide you working capital. And also at the end of every month, I give you your earnings because of the working capital facility I have. So with that monthly cash flow, you're able to make your operating costs payments, the payment to the crew and the maintenance of the vessel, and also pay the bank for the capex. Whereas if you were the single ship owner outside the pool, for the 100-day voyage, you have to fund your operating costs, your capital costs, and your voyage costs.
So, what causes freight rates to move dramatically even when the global oil consumption demand has not changed much?
It's tanker rates are a function of two main aspects: volume of oil that we move, but more importantly, the distance that we move the oil. So that determines the tanker capacity available. The third aspect, which is also very key, is sentiment. So volume of oil, as you say, is actually gone down, not even the same as it was. The volume of oil moved. I mean, we're not talking about consumption. Talking about volume of oil moved has actually gone down because the Straits of Hormuz have been closed for quite some time. However, the distance we have had to move the oil has gone longer. So because now oil is not coming out of the straits, some is coming from Yanbu, some is coming from Fujairah, and now you have to move that oil longer distances to various places. Also, a lot of replacement oil has come from the Atlantic. So instead of doing Saudi Arabia, Japan, now your Japan is buying oil from Guyana, is buying oil from the US, is buying oil from Nigeria or Angola. All those are longer distances than Saudi Arabia to Japan. So the demand for tanker shipping has gone up because of the distances going up. Japan was buying 90% of their oil, crude oil, from the Middle East. If I was the CEO of a company where I was buying 90% of my energy needs from one source, I'd be fired. But so basically now they're diversifying. All countries are diversifying. So China was importing 60% from the Middle East. Korea was importing 70% from the Middle East. India was importing 55% from the Middle East. Now, all these countries are looking to diversify, which means the distances that oil has to be carried have grown, are going longer. So, therefore, demand has gone up. And the third aspect is sentiment, like I said. So, when you have risk, where there is the risk of war and safety in the Middle East. So going through the Straits of Hormuz is very risky. Even loading in Fujairah outside the Straits is risky. Going to Yanbu in the Red Sea because of the Houthis is risky. Loading in Novorossiysk in the Black Sea because of the Ukrainian attacks is risky. The Russians are sanctioned. So there's a lot of risk built in to the into the market that changes the sentiment of the market. So effectively, charterers want to take the ship earlier, they want to capture the capacity, so they're willing to pay more. And then, of course, oil is trading at $90. So if you do look at the cost of freight in that barrel of oil, so if the delivered cost is $100 per barrel, freight is 4, 5, 6% of that delivered cost. So it's a small fraction. So they can still, even with the numbers that they're paying, it's a small fraction of the delivered cost. So today, a VLCC delivers 2 million barrels of oil at, let's say, $90 per barrel. It's about $180 million cargo. If the freight is whatever, 20 million, depending on the distance that the ship is going, it's still only 20% of the delivered cost.
So we often hear about the concept tonne-mile demand. Can you explain it to us with a simple example?
Yeah, so ton-mile demand is what I just talked about, right? There is the volume, which is the ton, and the distance, which is the mile. So tanker demand is measured in ton-mile. So the ton-mile from Ras Tanura to Japan, so Saudi Arabia to Japan, versus US Gulf, Houston to Japan, is like double. So the voyage from Ras Tanura to Japan is about 20, 22 days, something like that. Whereas from US Gulf to Japan is about 38, 40 days. So it's almost double. So ton mile demand, the same 2 million barrels are carried in 22 days versus 40 days. So ton mile demand is the real indicator of tanker demand rather than just the ton. So if you're carrying 2 million barrels, that does not tell you anything. It's about what distance am I carrying that 2 million barrels.
So when we look at the Hormuz disruption now, it's a major choke point. And in this situation, people always focus on the price of oil, right? When there is a disruption. What happens behind that headline? What happens to the vessels, the routes, and the freight rates?
Yeah, so the price of oil is just the symptom. Behind that is the problem, the major problem, which is now, as you talked about the Straits of Hormuz, the Middle East was exporting about 20 million barrels per day of crude oil and petroleum product. And so now that is suddenly disrupted and has disappeared. And so some of that oil was replaced by oil being pumped from Saudi Arabia to the Red Sea, to Yanbu, and exported from there. So now there's the cost of the pipeline. There's the war. So because of war, the insurance costs go up tremendously. And so there is that aspect, freight. So all this that you see in the symptom, the oil price, is a factor of that there's oil that has been shut out of the markets. So that creates a scarcity factor and causes the prices to go up. There is a cost of moving that oil to the consuming center. And so that cost is the pipeline cost, the shipping cost, and then eventually getting it to the refiners. So all of that then reflects in the oil price. But of course, the main thing is that the routes, and right now you're only talking about the war because you're talking about the Middle East war, because that's not, we have three wars effectively on right now. I mean, there was the war in Gaza, there is the war with Iran, there is the little mini thing that's going on with the Houthis, and then there is the Ukraine-Russia war. All those factors have caused oil prices to come up, but they haven't come up as much as was expected when the war broke out. People thought we would be seeing $150 per barrel, but we did not get to that place because the oil reserves that the countries had were quite large. I mean, China had built up oil reserves to almost 1.3 billion barrels. So they were able to cut their imports without having a marked impact on their consumption. They released oil into the domestic market. They also released oil into the international market and sold some oil. The US released oil, Japan, OECD, everyone released their stocks, which is why we have seen oil prices still under $100 a barrel. However, now stocks have been run down. So if the straits stay shut for a long period of time, this will start to see oil prices creep up above $100 a barrel. So the tanker market is very flexible. Ships can move. They can. We have different sizes of ship. So depending on the demand, where the sources of oil are, we're able to move the ships around. And so we, in the last 6 months, we quickly adapted as an industry to the closures of the Strait of Hormuz. Even then, we were able to get some ships in and out of the straits. Even today, there are ships going in and out of the straits. Very small numbers, but still are going out. And then, of course, we still have ships going into the Red Sea, and we're still ships in the shadow fleet, which are carrying oil for the Russians.
Okay, so in this situation, the ships are being routed to different ports depending on the conflict, and that directly translates to more ton miles. So
Correct.
can we say it's counterintuitive? What is negative for the oil market can sometimes be positive for the tanker market?
I don't know if I would say it's negative for the oil market, right? So if you look at the oil companies, oil traders, the results are phenomenal with the high oil prices. So maybe negative for the consumer because the oil prices have gone up.
Yeah.
But wherever I would put it another way, disruption in the oil market is good for the tanker market and for shipping markets in general because that disrupts the usual flow of oil. And so now you have a disruption in efficient trading. And because typically, if you think about it, Russian oil should go into Europe, Middle East oil should go into Asia, but now Russian oil is going long haul somewhere else and not to Europe. And now Middle East oil will not go all to Asia as it was and will be dispersed. And so Asia will be buying oil from the Atlantic as well. So they will cause longer distances. So disruption is good for shipping. And even for the container market, if you go back to see what happened with COVID, there was a point in time with COVID, everything collapsed, but then everyone was sitting at home and shopping, and people wanted to build up inventories. So container market since COVID, since 2021, has been on a bumper ride and has seen markets unseen for the prior 30 years. The profitability in containers for the last 5, 6 years is more than what they've made in the previous 30 years.
Yes. So we have lived through a prolonged disruption in the Red Sea. What has that experience taught the shipping industry in terms of how quickly the routes can change and sometimes how slowly they can come back to normal?
Look, because risk, the ships are not run by robots, right? Ships are run by human beings. We have 22 people on board the ship. So the risk is to the vessel and more importantly to the people. We cannot risk lives of people going into risky areas where they are being attacked with missiles, drones, and so on. So when things happen, when risk comes up, where ships are at risk, lives are at risk, the changes are instantaneous. The changes are instantaneous in terms of insurance. Insurance goes up overnight as soon as something happens. And then we assess the risk on a live basis. If we see that there is risk of life going in, we basically don't send the ships in. And even where ships are going into the Straits of Hormuz, it's always with the approval of the crews. If the crew say no, then the ships don't go in. Basically, we do not force any crew members to go into any war zones. So the changes in the trade routes are instantaneous because straits have closed, there is risk, there are missiles being fired on ships. So then that close up. Now we have to find alternative sources of oil. The consumers need alternative sources of oil. So the ships adapt to the new route. Changing back, so now we're talking about the Red Sea, changing back takes time because you need to have assurance that this change is permanent. So I was asked when the memorandum of peace was signed with Iran. I was asked by one of the news sources, so what happens now? Like, what we need is a framework to know what is the framework to go in and go out, and also how long do we see this thing lasting? And true enough, it did not last. And the framework was not consistent either. Within a few days, weeks, there were disagreements, and so ships were not safe going in. So changes back to the norm take a long time because we have to have assurances that the changes taking place are more permanent and not just temporary. So insurance is not willing to change their outlook right away. So also they're making money, and but they're unsure that the risk that they're taking has gone back to normal so soon.
So, if we step back from this situation, these are temporary disruptions that we see. But do you see the global energy trade map fundamentally changing in any way?
I think it has already changed. If you look for the Russia-Ukraine war started in February 22. At that point, about 40% of European oil was being bought from Russia. That's not going to happen. Even if sanctions are lifted, that will never go back to that situation. And a similar situation was on gas as well. I don't think that is going to happen again. I don't think the Europeans will trust in Russia the same way as they did 5 years ago. With regards to the Middle East, as I just mentioned, there is no certainty. I mean, any deal can be signed between any parties, but there is no certainty that deal will be in place. So, because of that, diversification of supply is critical for all the countries. The third, so one is the diversification that is happening across the globe, and then the other one is stocks. The countries that had reserves were okay. China, Japan, the US, most of Europe. But many Asian countries had no stocks. 2 days, 3 days, 5 days, 10 days. And so they did not pay the $90 a barrel that you see as the market. They paid $140, $150 a barrel for the prompt cargoes that were available that they needed to keep the refineries running. They had fuel rationing. They had the super high prices. So all countries now across the board are looking at the reserves and saying, okay, I had no reserves, I need some reserves. The countries like India who had some reserves are saying, I need more reserves. So effectively, that is a fundamental change in the market. We're going to have more reserves. So the countries that had no reserves will build reserves. There will be replenishment of reserves because, for example, US strategic stocks are down at record low levels we haven't seen since the 80s. So that has to be rebuilt. And then the diversification, which is also a fundamental change that will happen, is happening as we speak.
So we've also seen there is a huge growth of oil in the Americas recently. How does that impact the tanker market?
Again, positive impact, right? So Venezuelan production has doubled since January. Argentinian production has gone up to almost 1 million barrels per day and will keep going up. They have a huge scale driven growth in production. Canadian production is growing, and American production is still, US production is still growing. So the region in general, in terms of the demand, is a net exporter of oil. And so we see a lot of that oil going to Asia. This is the diversification that I was talking about, right? So now Japan is buying oil from Mexico. Mexico does not have that much to export, but Canada does, Argentina does, the US does. So I think we will see a lot of diversification from that aspect because Americas will fulfill. And I did not even talk about Guyana, where again, Guyana is about to hit 1 million barrels per day. A new FPSO will start production shortly. That's another 250,000 added. So they will go to 1 million barrels per day. Venezuela, as I said, has doubled to 1.25 million barrels per day. Brazil is expanding production. So Brazil is going to be a huge source of exports as well. So the Americas will be a provider of oil to Asia and some to Europe. And then Russian oil, we'll see where it ends up. Right now, it ends up mostly in India and China, some in Africa and Latin America as well. But I think we are seeing a complete dispersion of trade.
So, with respect to sanctions, we've seen trade routes have changed. Do you think even after the sanctions are lifted, those routes will be sticky, will be permanent?
I think it will not be 100% the way it is. So, for example, Venezuelan oil, while it was sanctioned, went mostly to China. Iranian oil, while it was sanctioned, went mostly to China. Maybe some other small trades, whatever, but mostly to China. Russian oil today is going mostly to India, China, and some to some other countries. I think when the sanctions are lifted, when Iranian sanctions are lifted, it will go, to some to Asia, but will probably end up also in India and in Europe and elsewhere. Russian oil logically should go to Europe, but I don't think that will be the case. So it will still carry on. But will it be 100% like the way it is right now? I don't think so. There will be some European countries like Hungary, etc., who are more keen on buying and maintaining relationships with Russia. And so they will start buying again.
So, you've watched this industry for almost 4 decades. Does today's tanker market look like another cycle to you, or do you genuinely feel anything different this time?
I think it's different this time because it's driven a lot by what has happened with this combination of sanctions. So if you go back 30 years ago, we did not have this thing like sanctions, right? Okay, we had a little bit of the Arab embargo, etc. But the effectively, in a way, you could call this that we are in the Third World War. It's just that it's not a world war like it was defined earlier, but we are in a situation which is between the sanctions, the economic sanctions, the war in Ukraine, Russia, which is also a proxy war, and the Middle East war. We are in a war-like situation. So everything, the market is not driven by supply-demand fundamentals alone. It's driven by external factors as well. And those external factors are not just short-term factors, are also longer-term factors. So I think it is a bit different. But I will say that, long-term, my market is the most efficient market, is driven by supply and demand. So I'm not saying that we will be in this high cycle forever. At some stage, things will change. And the volatility, which still exists, will also come more on the downside. But at this point, we do not see that in the next, let's say, 18 to 24 months.
So, when we see the tonne-mile demand increase, how does the tanker market respond? Can you simply build more ships?
Uh, there are two ways we respond, right? So you need capacity. So there are two ways. One is that instead of recycling old ships, which we would have done, we have extended the life of those ships. So oil companies in the past used to have a hard line of 15 years for most of the big ships. Then they sort of pushed it now to 20 years. So in the past, many of the, I won't name the companies, but even the Chinese companies, for example, never worked with ships over 15 years. The Russians were very particular about using younger tonnage, never used old tonnage. So we have now changed that where, the Russians are using old tonnage in the shadow fleet. The Chinese are being more flexible. And all oil companies are being more flexible. So the age of the vessel that can be used, the economic life has been extended. And then the other part is new ships. So new ships to build generally take 12 months now. It can be even shorter, 8 to 12 months, depending on the shipyard. But the yards are now full. So if you go and order a ship today, the earliest berth you can get is probably now 2029, and many of the yards are even quoting now for 2030. So and it's because the order books are full. So there are ships coming in 27 and 28 for all sizes of tankers. So the tanker fleet will expand if there is no scrapping. So we are responding already to that demand factor. The ship owners made money and they started ordering ships. The ordering was initially fueled by the fact that they wanted to renew their fleet to get more efficient ships, decarbonization, etc. But in the last 18 months, especially the last 1 year, has been fueled by the fact that earnings are so high that you can pay off the ship in a very short period of time if the current rates carry on. So that's why people are ordering ships.
So, how is Heidmar positioned for the environment you've just described?
So we are able to take advantage of this strength of the market that I just described, the volatility in the market, without having any capex. So if we fix the VLCC at the height of the war at $25 million for a 15-day voyage. On that cargo, one voyage, I made $400,000 in commission, just from the fact that I knew the owner. He gave me the ship to manage commercially, and I knew the charter on the other side, and we fixed the voyage. So we are positioned to basically take advantage of this because we currently operate, excuse me, 50 tankers, and we are expanding. We have another 6 tankers which are joining the fleet in the next 4 or 5 months before the end of the year. And we have another close to another 25 VLCCs that will join in 27 and 28, and another 4 or 5 new building Suezmax, Aframaxes. This is just what we know. I'm not even talking about what we will market and get more. It's just from what our existing clients have in their order books and what they have said they will give to us is where the growth is already built in. And then this is the commercial management aspect of it. On the technical management, the addressable market is huge. We're not trying to be the largest at this point, but with the boutique manager that we have, we're growing on that aspect. And the growth there can be manifold. At this point, we manage about 20 vessels. We can grow to 100, we can go to 200. There is, that market has huge growth aspect for us. And people like the product that we are offering in terms of service. So we see a lot of prospect for growth on both the commercial management and the technical management aspect.
So, how is the asset light commercial management model benefiting from this environment?
Look, I mean, my clients are the ship owners who have invested heavily in the assets. They are the ones who are making the billions, the millions. However, we are not investing the billions, we are not taking the risk because the ship owner clients of mine, while they are enjoying the upside, they also are exposed to the downside. They are the ones who have borrowed money from banks to pay for these assets. They put in equity to work. They take the operational risk of all this, whereas I do the commercial management and make most of my money there. So, from my aspect, being asset light, if today a ship owner came and said, "Take my 20 vessels to operate," I already have offices around the world which are required. Maybe I will hire 1 or 2 accountants. Maybe I will hire one operator. My cost for doing the entire thing is maybe $150,000 a year to manage that extra 20 vessels. So, and whereas those 20 vessels to me could generate I don't know, 5, 6, 7 million in revenue, maybe even 10 million revenue, depending on the market. So the asset light version gives me the flexibility to take advantage of the heights in the market. And then when the market goes down and it becomes more difficult to fix a ship, all these owners who are operating on their own then come to me and say, look, I need the cash flow, I need the economies of scale, I need the flexibility of the pool. Can you take my ship and operate it? So I get then the volume. In the high markets, I get the high margin. In the lower markets, I get the volume because more ships come to pools when the markets are down. So, we've been in this market for 41 years. This is how not only that we have survived, but we have thrived and made a lot of money doing this along the way. Also, one other thing that we do is on my own proprietary book. So when the markets go down at the right time, we take ships in on lease. So I did that in January of 22 before the market went up. On one ship, which I chartered for 1 year, I made a $10 million profit. My investment on the ship was zero.
Zero
Zero. I took
capex.
the ship in, yeah, zero capex. I took the ship in on lease. The rate was $23,000 per day. I operated it in the market for 11 months and few days, and I made a $10 million net profit on that ship. So this is the other thing that we are sitting on information, we are sitting in the market, people will charter to us. So even today, I have two ships chartered in from a national oil company where we took the ships in at around just under $23,000 per day. And now we have chartered out profitably to somebody else. And we're making money. On the 2 year or 1.5 year that we have fixed out, we'll make $4 or $5 million profit. So, there are many ways for us to make money in this market when we are sitting in the market and with the information that we have and the relationships that we have.
So for a macro investor who doesn't follow shipping, are there 2 or 3 indicators you would suggest them to watch?
I think, price of oil is obviously one indicator to watch because that has an impact on both sides. High price of oil generally means people are also producing or trying to produce as much once prices go high. Or if on the other side prices are low because of a reason, it's because demand has gone down, maybe supply is too much. So oil price is definitely one indicator to watch. The other is, of course, now in terms of data is available, and you can see what is happening with flows. If you International Energy Agency produces a monthly report, after 20 days that report is available. So it's a little lag indicator, but you can see what's happening with trade flows, and you can see where things are going. So oil demand indicators are available from the International Energy Agency. And then, of course, there are indicators from the rates as well, which are available online, and you can see where the rates are. And rates inflect very quickly. You can see the moment you see the rates start to inflect and earnings go up, the tanker owners are going to make more money, and the people and Heidmar, for example, will. So we are when the rates go up, almost instantly it is impacting my bottom line and reflected on my bottom line. Within a quarter, you will see it on my bottom line.
Pankaj, thank you for joining us. It's been a fascinating conversation, and I think our viewers will have a better understanding of how shipping connects to oil, trade, and geopolitics. Thank you for sharing your perspective and experience with us.
Most welcome. Happy to do so.
And to everyone watching, thank you for joining us for the first episode of MarketVelugu Conversations. Until next, pause, reflect, and observe. Signing off.